One of the most important things to learn is understanding price bars. How is price represented graphically, visually, so you can a chart, so you can start identifying and you can start using it and start using indicators to make decisions. And you think of that concept of a picture is worth 1,000 words. Well, that's the idea where price bars are going to represent things as far as what's happening with an individual security. And there's several different types of price bars. We're going to learn about them all, but they're the key building block, and some are real powerful, like a candlestick bar. We have a whole section just for candlesticks because they're such a powerful way of representing things in a price bar. But as basic foundational, price bar, to represent price at the basic core level, and the key one to kind of start with and then kind of grow from there are what are called OHLC price bars, or they stand for open, high, low, and close. Pretty simple. So if we look at, let's say, this price bar on this graphic here, you can see on the left is the prices going up and down in time, going from left to right. Farther back in time is left, more recent time is to the right as prices go across. You'd see that represented on a chart. But if we think of price just in the price bar aspect, you can see this like straight line up and down, and it's got two tick marks, one on the left and one on the right. Not sure how that visually came across to the camera, but you can kind of see on the idea that there's one on the left and one on the right and one in the middle here. And basically, if we were looking at this particular price bar, or any price bar, you can see that it has a high and a low. That's its trading range. So let's say if this was a daily price bar, a daily OH, open, high, low, close. So for the day, we can see that the prices fluctuate between a low and a high. Now we can also see from this price bar, it tells us even more information. We can see what the price was at opening. When the markets opened and they rang the bell and the markets opened, people could start trading. This was the first or opening price. You can see where that tick mark bar is on the left there. And you can see that this, might be a little bit closer to the low. In this example, it doesn't have to be, but in this example it is. And then it trades through the day in the high and the low, and then on the right you see another tick bar. That's the closing price. That's what it ended up at the end of the day. So that was the last price that was traded at in that trading day. We can look at that high and low. The difference between the high and the low, by the way, is the trading range. The range of prices. So prices didn't go above the high, prices didn't go below the low. They're within that trading range there. So that you can see with the name of it, open, high, low, close, pretty simple, right? So if we look a little bit closer at that, if we see an opening, it's above the previous day's close, that might be an indicator that maybe a price increase is coming, that we want our security prices to rise, right? If we're buying, we want them to rise. So if they are opening, before, above a previous day's close, that can be an indicator that prices might be rising. The opposite of that would be if it goes below, the previous day close, that maybe a price decrease is coming. Now, I wouldn't trade just on that. We want to have a lot more than that, but that's the general idea as far as, looking at an opening versus a closing. But a lot of people don't put a lot of stock in openings, I will tell you. Whether you put more emphasis on the closing price, that's more important. That's the most important. It's really kind of a summary of the trader sentiment for the day, right? It could open at anything, but at the end of the day, after we had this highs and lows in this whole trading range, at some point there was trader sentiment and it closed. The last price of the day was the closing price, and that was where the trader sentiment had. And that's where a lot of people will buy and sell right towards the end of the day to close positions or kind of lock in where they want to be. And they're deciding, do I want to hold this security overnight, or which might be yes, which might be a good positive sign, or am I selling it more and driving that closing price down? Because no, I don't want to hold it overnight because I don't believe in it as much or whatever. So that it's in a real microcosm of just a day, you can kind of get this feel for what sentiment might be within that daily thing. And then whatever it opens up the next day, well, that's an opening at that point, but you can get a good feel for the closing prices. And that's why when a lot of people are looking at prices and trends, they're really looking at closing prices as far as using mathematics or some of the things we'll learn about when we're looking at averages and stuff. They'll typically use a closing number versus, let's say, an opening number. If the close is, let's say, now we want to see, well, how can we use this in a simple price bar? If the close is higher than yesterday's close, so it closed here yesterday, and today it closed at this, and then what might be happening for tomorrow? If they're closing higher day after day, that means there's more demand for that particular security, and people are willing to pay higher prices for it. So that's pushing the security up, and that would indicate really kind of a good buying trend, right? Because the closes keep going high. So it's a strong buying signal as the close is the high of the day. If the actual peak of the day is the actual close, it comes real close to that high of the day in the trading range. That means that people are really buying at the peak right up to the last minute, and they want to carry it overnight. So they're really like, I want to get in and I want to buy up there. So that can be a real strong indicator when you have your close near the high of the day in that trading range. If the close is lower than yesterday's close, kind of the same thing, but the opposite. Day after day, less demand, and people are willing to sell, and they're willing to sell at lower prices. You have more of a selling trend versus a buying trend. So you can look at those closes as far as looking at trends, and we'll be learning how to draw chart lines and trend lines and all sorts of stuff so we can kind of graphically represent this. But that concept of higher highs is good as far as buying, and lower lows might indicate selling. And that can be, represented here with like different sentiments. Like, if you have, let's say, the price bar on the left, that might be considered a bearish or a downward type of sentiment where we have our normal high-low range. But you can see how the opening opened up pretty high, but then the closing was way down more towards the low part of the range, and the close was below the opening. That would be a bearish or a sales sign in a single day price, looking at price. But if you look at the one on the right, you can see where it opened lower and it closed up higher, right? So that could be more of a bullish thing. And actually, if you were looking at more tick bars, it'd probably be represent bullish would be more of a black line or green line versus red line. But you get the idea here where it opens lower and closes higher is the idea of something that would be bullish looking at opening and closes. Now, the daily open, high, lows, close, you also want to consider the high and the low too. What was the highest trade of the day? What was the highest price of that trade, in effect? And the relationship to the previous day's close and high is important as well when you're looking at a series of prices over, let's say, a chart. Same thing, the lowest trade is the lowest trade, or the low is the lowest trade of the day, and you're looking at that relationship to other bar parts like the opening in particular, or a lower open may mean that they may be factoring in new stuff, or trending lower. So you're looking at that range of price bars. So the pricing, price bar can tell you quite a bit, and that trading range can tell you quite a bit too. How big is the difference between that high and low bars? Is it a real short, difference between the high and low, or is it a really long, vertical line going up, and there's a wide range of prices that things are being told at. So you want to compare that in relation to maybe other price bars that are preceding it. And you can start seeing that if there's a small range in the sea of larger ranges, where all of a sudden the price bar you're looking at for the most current day or most recent day or time period, whatever that is, you can see that, well, it would be a day, you can see that, maybe the ranges are getting smaller, then there might be some indecisiveness happening. They're trying to figure out, do we go higher, do we go lower, looking at that trading range. Same thing if the range is large in the sea of smaller ranges, all of a sudden everything's going small, small, small as far as a high and low range, all of a sudden it starts to get really big. That, big wide range, that might tell us that an event or something is happening. People are trading more actively. There's a lot more interest in this particular security. So something might be changing. It could be going up higher, it could be going up lower, but it's an indication with trading range that something might be happening. And you can also link that to the volume, how much trading is going on too, because trading range is just looking at the price, where volume's looking at the actual number of actual trades happening, and then together they can give you some good indications.